So you're thinking about getting into real estate, right? And maybe you're looking at a big apartment building and thinking, hey, that's just a bigger version of a rental house. Well, I'm here to tell you that's completely wrong. We're talking about two totally different worlds. Let's dive in and I'll show you exactly why. Okay, right off the bat, this is the single most important thing you need to get. A residential property? Yeah, you can think of that as an asset, something you own. But commercial real estate? No way. That's not just an asset. It's a living, breathing, complex business, and you have to run it. So, here's our game plan. We're going to look at these two worlds, then talk about the language of value, how you even figure out what the stuff is worth. We'll get into the nitty-gritty of deals and documents, what it actually takes to manage the machine, and then we'll zoom out and look at the big picture, the cycles, the risks, and how you get out. All right, let's jump into our first section. It's really easy to think the difference is just about size, right? Big building versus small house. But that's not it at all. The real difference, the fundamental one, is all about its purpose. Think about it. A house, or even a little fourplex, it's built for people to live in. It's what we call a consumption asset. But an office building, a strip mall, a big apartment complex, those things exist for one single reason: to be a business that makes money. That's it. Full stop. Okay, so because their purpose is so different, it probably won't surprise you that these two worlds don't even speak the same language, especially when it comes to one of the most important questions. What's it actually worth? So that's the big question, right? How is real estate valued? And the answer is, well, it totally depends on which world you're playing in. This is where it gets really fascinating. Residential valuation is all about looking in the rearview mirror. You look at comps. What did the house next door sell for? It's all about history. Commercial, on the other hand, is about looking through the windshield. It's valued based on its future, its ability to generate cold, hard cash from its tenants. And to understand that future, you have to know this one term. It's the king of all metrics in commercial real estate: net operating income, or NOI. Think of it as the property's pure profit. It's all the money coming in from rent minus all the money going out to run the place, before you even think about the mortgage. This number is the absolute lifeblood of the deal. All right, so if NOI is the lifeblood, the second term you gotta know is the cap rate. The cap rate is like the market's pulse. It basically tells you what kind of return you'd get if you walked in and bought the whole thing with a suitcase full of cash. And here's the key: a low cap rate is a good thing. It means the market thinks your property is a safe, high-quality bet. And this is where the magic happens. Look at this formula. It's so simple, but so powerful. Value equals your net operating income divided by that cap rate. This isn't some guess. It's math. Your property's value is directly tied to its income. And this is the whole game right here. If you can figure out a way to increase your NOI, get more rent, cut expenses, you literally mathematically force the value of your property to go up. It's incredible. Okay, so we've got the theory of value down. But how does this whole "it's a business" thing actually work in the real world? Well, it's all about the paperwork. The business of CRE is built on a mountain of complex, ironclad legal documents. And just look at the leases. The difference is night and day. A residential lease, it's usually a standard form. Maybe you sign it for a year. A commercial lease? That's a 50-page monster. It's a long-term business contract that locks in a partnership with a tenant for 3, 5, 10, even 20 years. And it's not even that simple. There are all different kinds of commercial leases. As you can see here, it all comes down to who pays for what. Who pays the taxes, the insurance, the maintenance. In some leases, especially a triple net lease, the tenant pays for pretty much everything. They are essentially running the building themselves and just sending you a check. This business-first thinking completely changes how you get a loan, too. For a house, the bank is betting on you. They want to see your W-2s, your credit score. For a commercial property, the bank is betting on the business. They care way more about the property's income and its tenants than they do about your personal salary. And because they're betting on the business, the lenders have some serious rules. They're not going to give you a 95% loan, and they have this thing called a DSCR, the debt service coverage ratio. It just means the property has to bring in enough cash to cover the mortgage payment plus a healthy cushion, usually at least 25% extra. See, they're underwriting the business, not just you. Okay, we keep saying it's a business, so what does it actually take to run this thing day to day? Let's talk about the reality of managing the machine. Just look at these numbers for a second. Let them sink in. To buy a house, you might spend $500 on an inspection. To buy a commercial property, your investigation, what we call due diligence, can cost 50 grand, 100 grand, $500,000, or even more. The question is, why the huge difference? Because you are literally putting the property through a gauntlet. This isn't just one guy with a flashlight. You're hiring a team of engineers, environmental scientists, lawyers, accountants. They're all there to audit every single lease, every financial statement, and every square inch of the property. You're basically putting the entire business under an MRI. And this really drives the point home. You absolutely cannot do this alone. To succeed in commercial real estate, you have to think like a CEO. And this is your board of directors, your executive team. You need every single one of these specialists on your side to get a deal done and run it properly. All right, let's pull back and look at the 30,000-foot view, because owning one of these properties isn't just about cashing rent checks. It's a long-term strategic game. You've got to play chess, not checkers, with economic cycles, risks, and eventually your exit. And because CRE is a business, it's tied at the hip to the health of the broader economy. When interest rates go up, it hurts. When a recession hits, your tenants might struggle. And think about massive disruptions, like the shift to remote work. That's a huge risk that every office building owner is having to deal with right now. And finally, when it's time to sell, you don't just stick a sign in the yard like you would with a house. Selling a commercial property is a planned disposition. That's a fancy way of saying you're selling a business. You have to package it up with detailed financials, market it to a very specific group of buyers, and the whole process can easily take 6, 12, even 18 months. And that brings us right back to where we started, to the single most important idea of this whole thing. If you take away only one thing, let it be this. It is an essential, non-negotiable mindset shift. You have to stop viewing the property as just a thing and start seeing it for what it is, an operating business. So I'll leave you with this question to think about. What kind of investor do you want to be? Are you an asset owner or are you a business operator? Because your answer to that question will tell you everything you need to know about which one of these two worlds is the right fit for you.